Just as we've been saying, yeah, so revenues are down,
Yeah.
but a big jump in earnings, but particularly impressive when you consider it at the basic headline earnings per share from continuing operations up 92-93%.
That's
How
correct.
was that?
So I think the key thing there is you would recall during our past financial year, we entered into a number of disposal transactions. The one in particular was the disposal of our enterprise solutions business, which was a once-off project-based large-scale SAP implementation business.
Right.
That business, in times when we're experiencing at the moment recessionary, did battle to deploy resource into key projects. And therefore what you had as a consequence is quite a material impact on your bottom line and your margins. So we do see some significant margin improvements in this 6-month period, and that's part of the consequence of some of the exits that we had were able to achieve during our past financial year.
So talk us through this strategy of focusing, as you call them, on core annuities.
Yes.
And taking perhaps a less kind of look on the light project, the light once-off projects with light revenues. Why did you take that decision?
So it's always been fundamental to UCS to focus very seriously on annuity revenue streams. In fact, our current revenue makeup is around 55% annuity. What we found was in the times when things were pretty good, obviously a combination of once-off revenue and annuity revenue enabled the group to grow quite nicely.
Right.
However, as we moved 2 or so years ago into more recessionary type climates, particularly on the once-off side and in respect of significant projects, where those significant projects were no longer available from a retail perspective, the impact for our business on the bottom line was quite detrimental. So we've taken a view strategically that we would like the mix of our revenue makeup to be stronger annuity,
right,
to give us the better predictability around our profits,
okay,
and therefore our cash flows,
right,
just to add the sustainability to the business.
So what's the balance now?
So we're still sitting right now at 55%.
Okay.
We typically say that we would like our overall revenue makeup to be somewhere between 50 and 6%,
okay,
50 and 60% annuity.
Okay.
The rationale around that is that we would still like to see some once-off sales taking place, not necessarily linked to projects,
sure,
but for example, the on resale of technology could contribute once-off revenue to our business. And we are focused on revenue growth, so it's important to us to continue the once-off type revenues, not project necessarily related.
Sure. So let's talk about the retail environment. I mean, when probably someone is watching here and we're talking about software development, they think, oh, who's UCS? They don't affect us. But you are intimately connected to the retail sector. Just give us a breakdown of what kind of work you do there and what kind of environment you're seeing from the retailers that you deal with.
So I think in terms of the kind of touch points within retail, if a consumer goes into a retail environment, typically the technology touch points within that retail environment, whether you purchasing something at the point of sale, whether you swipe in your credit or debit card to effect payment, those are the technology touch points that UCS generally sits behind. Correct. So when we talk software development, we're talking about software development that relates to the in-store point of sale requirements of the retailer, the secure payment device requirements of the retailer, and then behind that, obviously even up into central, some of the more intellectual type of aspects of the technology from a warehouse management perspective. Those would be the various areas that UCS would play.
So how is that environment now?
Definitely, we're finding on the food retailing side that the market still seems to be fairly robust, but in terms of non-food retail, it's still very, very much under pressure. As I believe, domestically we have consumers that are still very much under pressure. So it's unfortunate that the trading environment we've experienced in the last 6 months very much been a continuation of what we experienced in the previous financial year.
Yeah, I just would like to apologize if you're hearing the sound that's going on behind us. It's construction here in the JSE. They are building some stuff here, so just excuse us for that. Quickly, Dean, let's talk about the highlights of this reporting period.
Yes.
2, there was the cooperation and collaborative agreement with Codis.
That's
and
correct.
Secondly, there was the 56% acquisition of a 56% stake in Cquential.
That's
Quickly,
correct.
what did those bring?
So very exciting strategic progress for us. The Cordis one in particular is a global collaboration agreement that we've signed with Cordis based in the Netherlands. It entitles us to embed Cordis technology into our future UCS product offering, which we'll be looking to offer not only locally to the South African market but internationally. In fact, we've been successful in selling the first instance of Cordi standalone already within a significant tier 1 retailer in South Africa. So that's very exciting for us in terms of our future product offering. The Cquential acquisition is complementary to what we already have in Aquitech in terms of warehouse management, supply chain distribution application. It effectively is exciting because it's structured as a software as a service application, which enables us to offer that on a rental model to retailers. Makes it more affordable for retailers below the tier 1 corporate level to actually deploy an application that can manage their warehouse. And that definitely for them could enhance margins and so on in their operations as they get better control and management around their inventory.